Good afternoon, Mr. Ryan. How you doing today, sir?
Hey, what's happening, Mike? I'm doing well over here.
Good. So today's topic, we were chatting a little bit offline on this, but some people are trying to compare the current housing climate and environment to 2008 when everything went completely sideways, and I'm sure that that's what everybody's afraid of happening here again. So you want to dive in a little bit on that so we can debunk that myth?
Yeah, for sure. So, that's the easiest thing is to go back to the last bad thing that happened to us. And so that when things feel a little bit heavy, on the housing side, prices are up, rates are up, we go, well, it has to crash.
Yep.
And if it's going to crash, we go back to our recency bias pulls us all the way back to 2008, because that's when that was the big gigantic crash that we all experienced. We all kind of remember that. And so we draw immediate conclusion to that. But
Yep.
there's some key differences between this market and 2008. And I think that's what we wanted to go over today.
Yep.
We've got a nice little slide to kind of just bring forward, a few of the key points that we can talk about on this one. So I'll jump on. Actually, I'll let you grab the first one, Mike, if you want, and then
Okay.
I can add a little color to it. We'll just kind of lobby back and forth on these.
Yeah, okay. So with job cuts, I mean, man, back in 2008, I don't know how many people remember that because it wasn't as relevant in their lives as it was for us. But there was huge layoffs going on everywhere. Banks, like entire banks closing, right? Like Countrywide and Washington Mutual, and people getting bought up by other banks like Bank of America. And we saw a lot of that here for sure because we have the call centers and everything that were here. But nationally, it was a big deal across the board. But this year, not as much, right? I mean, we were discussing offline the latest jobs report that came out, and why don't you cover that real quick on the number of new jobs and all of that?
Yeah, so leading into 2008, there were 8 million job losses.
Mm-hmm.
Okay, so, and that's all sectors. You mentioned kind of in the finance world. Obviously, that's where the core of that recession was based on, but there was all job losses. I mean, it was just a gigantic, nasty recession. Housing was kind of the stimulant to that, and it just kind of blew up from there.
Yep.
Today, the most recent job report came out last week, was plus 512,000 jobs. Now, it doesn't mean that there's no job loss. There's obviously some job loss, but there were enough job gains to have a positive number
Yep.
by over 500,000 jobs. So very different. That's your first key indicator. Very different than what we had in 2008. We haven't seen all those job losses. Now, we may in the future, we head into recession, may start to see those, but we're not feeling those in the moment.
Yeah,
We're positive still on the job side of things.
for sure. And so that covers the job cuts and the total jobs and what's available out there, right?
Yeah.
So the
So
subprime loans hit that. I mean, you and I remember that very well. But for those who forget, what's a subprime loan?
Yeah, so subprime loan was really a non-credit qualifying loan. So you might have been in a position where you had good credit,
Mm-hmm.
you just simply wrote down on a piece of paper how much money you made. Nobody validated, they didn't look at your pay stubs, they didn't check your tax return.
Yeah.
But to qualify for the loan, you had to make a certain amount of money. So guess what? That was the number that you put down on your application. In some cases, you had to validate your assets,
Mm-hmm.
but in a lot of cases, you didn't have to validate anything. So you
Yeah.
could have had just money coming in from whoever, that you were the person with good credit. You wrote down how much you made and went into it. Well, bad things happen when you don't validate and check on it, because that person actually didn't even have enough money coming in every month to cover that new mortgage that they were taking on. And so that doesn't really exist today. We're checking out all of the income. All the documents are very supportive
Mm-hmm.
of what actually somebody can make and what they actually can afford. Very different than what we saw leading up to 2008. Again, 2008, very speculative. Just about anybody that can fog a mirror could get a loan.
Yep.
Today, not only do you have to fog a mirror, but you got to prove on paper you can actually repay that debt.
For sure. And they're a little more stringent now than they were even in recent history on the qualifications for that and the verifications for that, right? And in recent history, not 2008 when they didn't seem to care. So yeah, and there's virtually no subprime loans in the market right now, right?
Yeah, for sure. And actually, there are some creative lending. We call them non-QM or non-qualified mortgage. And so, those would be people that qualify with a bank statement, or maybe they qualify just the property on its own. That's called a DSCR type loan. So those loans exist,
Yeah.
but they're done at really, really high interest rates. So you might pay 3-4% over market for those rates, and you're going to need a pretty heavy down payment from day one. So you're going to need maybe 20, 30, 40% down just to get in the door on those. And the reason that that's important to kind of mention, those loans exist, but the people that are taking those loans are calculated investors. So
Oh, yeah.
they know what they're doing. They're putting a big amount of money up front. They're not going to lose those properties. They're going to lose 30% equity just because it was, they're trying to put somebody in and flip it, or they're trying to put somebody in and get a quick rent off of it.
Yeah.
These are long-term seasoned investors that are taking that kind of debt.
Yeah. It's going to take more than a bump in the road or a slight hiccup for them to walk
Right.
away from that money. So like a third right now, in an average sales price of 450, they're putting $150,000 into that.
Right.
It's a lot of skin in the game, right? They're not going to walk away from that. Unlike last time, it was peanuts. It was like 2% out of pocket, when all was said and done, they're, 15 grand or whatever it was on a 350 sales price. It was not a lot of money.
Yeah, toward the end of that, there was even 100% financing without any validation of stuff. So you really didn't have to have any money. Seller paid your closing costs. You bought the house with nothing, and you didn't have to prove that you could repay the debt. Well, what happens when it rolls back and off value a little bit? You just ditch the debt because it's too expensive.
Yeah. Or they're not emotionally attached anymore, right? We've had that conversation, like same with stocks. Anyway, prevent a rabbit trail there. Next category, new construction.
Yeah.
So,
Well, let's go back one. I want to go back to the total job. We skimmed over that, but I think there's an important key factor there. So leading up to 2008, 138 million jobs. Well, if you look at the slide here, current market, 158 million jobs. So this is one of the reasons why, and it ties very nicely into that inventory on market, new construction we're about to talk about, is there's 20 million more jobs today than there was in 2008.
yeah.
20 million more people earning money right now. Now, are they all homeowners or potential homeowners? No, but there's 20 million more jobs. And so when you have a situation to the next slide, which is basically the new construction, the 5 years leading into 2008, the average was 7.6 million homes were being built. Now there's only 4.6 million.
Yeah.
So you have 20 million more people that are working, that are making money, but they're building a lot less, almost half of what they were building up to 2008.
Yeah, for sure. And it's slowed down even now. I mean, with the construction costs and everything, or even just the loss of sentiment in the market, right? A lot of the new builders, new starts have declined, and they fell back below, a million again, which, we were above the trend line for a few months, but we're back below trend on what we need to have as far as new homes being built in order to sustain population growth. So we kind of fell under that again. And again, it's at half almost, right, of what we were in 2008. And I'm sure you remember, but back then, like the cities here, both cities stopped issuing new construction permits. Like Ana Verde basically got frozen in time because they saw the writing on the wall, and they weren't going to allow it to continue to be developed and have a bigger problem than they already did, right? So we don't see that. We don't see enough new construction here right now, let alone too much of it, right?
Yep.
So, and with that, like the new construction in LA County permits right now, just permission to build, just permission is like $150,000 on a single family residence. So it's not there. Back in 2008, it was like 60 grand is what the permits were. So it was much more affordable to get in with creative financing, to boot. And it was just a much different market than it is now, for sure.
Yeah, for sure. And then your next column there is the inventory on market. And so this is the area that, going into 2008, you had somewhere between, depending on what month you're checking it, 3.8 and 4 million homes on the market at any given time. So that's US numbers.
Yeah.
And today it's about 1 million to 1.2 million, although I just checked this, it was under 900,000 for a period of time here recently. So you've got a really, really low inventory level. And again, to go back to the amount of jobs that were created, there's 20 million more people making a check. So this is another reason there's so much compression in the housing market, is that you've got way less in terms of what's available for somebody to go and pick up. And includes rents. I mean, these are homes on the market for sale, but rentals, to go out and get a rental, there's not as many of those, right? So there's just a massive housing shortage. It's not just on the purchase side, rents included. That's why rent prices are so high. But again, 20 million more people working, it's more money to spend, more people that want to live on their own. And you got a little bit of an issue here with the inventory.
For sure. So, supply and demand drives everything, right? That's what pushed our prices up the way they are on both the purchase and rental side. But now here's where the next part where we'll really get into the eliminating the fear of what was 2008, because everything we've talked about so far was just leading up, right? They were all precursors to the problem. And so the real problem was the number of mortgage delinquencies. Going into 2008, that's before things really fell off. Like March, April locally of 2008 is when things just fell again drastically. But going into 2008, 10.1% delinquency rate, that's insane, right? And showing right now that we're at 3.6, and I have to imagine that a large portion of that 3.6 is actually from the forbearances from during lockdown, right?
Yeah, so mortgage delinquent would be really defined by a 3-month period of time where you've missed your payments. You're 3 months behind. You've got 3 lates, or essentially, right?
Yep.
So it's a notice of default. That's essentially the first step in that whole foreclosure process. Notice of default is filed. So that 10% of mortgages, that's what that was encompassing. Anybody that was 3 months or more behind. Now, 3 months or more behind, it could also be forbearance. And so to your point, you had a period of time where various industries were shut down, and they were not all at the same time. And some of them were staggered, and some came back to work early, and some took longer, where people were jumping in and getting forbearances up to 12 months.
Yep.
Well, those stack into that number. They're factored into that 3.6% number. It's also important to note 30%, or actually it's a little over 30% of all of the homes in the United States are owned free and clear.
Yeah.
So when you take and you just whack off a third of the houses, and look at the rest of that pie is just the finance stuff, only 3.6% of those homes actually have an issue right now. And a lot of those issues are going to get solved whenever they come out of forbearance.
Yeah.
The lender will defer that principal balance and work with them on their payment. And they have enough room to do that right now. They're not overwhelmed with that. And so it's an easier place for them to kind of make those changes and keep people in their house versus what we saw last time in 2008.
For sure. And even to that point, even of that 3.6, I would say the vast majority of that 3.6, they have chosen to be in default and have not sold the home yet, meaning I would say at least 3.25 of that 3.6, they could right now turn and sell the home and make a profit or break even at worst. So the number of people that are actually in trouble and underwater, like that 10.1% from 2008, it's tiny. And again, that's of 2/3 of the market, because 1/3 of it is on free and clear. So that should eliminate a lot of fear for people, and maybe take the wind out of some of their sails on hope of, waiting and buying a distressed property because the market's going to crash, right? Like that's, from everything that we've seen right now, and even really any trends that are coming up, that it's not going to happen.
Yep. And then that final line item, homes that are in foreclosure, was 4.6% of all homes leading up to 2008. That's gigantic.
Yeah.
It's under 1% right now. That number did double. And so there's some news articles going, foreclosures have doubled, but it doubled because there was forbearance on foreclosure for a period of time. So they had to get it. There was a catch up period from part of 2020 and 2021 that fed into 2022's number.
Yeah.
And so we're still incredibly low as it relates to foreclosures. And going back to what you just mentioned, there's plenty of those people that have a lot of equity that can get out. They're not 100% financed people that are in foreclosure. These are people that have had a nice runway for appreciation, If they need to get out, they can get out, still make a profit on their house, but they probably don't want to. They're probably going to try to work it out if they can. But some people will need to. Some people's situations are just bad and they can't afford to pay. They are in foreclosure. Meet with a good real estate agent who advises them properly. They can sell the house, walk away with a little profit, and everything is all good. Those homes never actually hit the courthouse. And so you and I don't have a chance to jump in there with cash and go buy those things.
Yeah.
And so right now, even if we did, I don't even think we'd get a shot at it because of the amount of private money, private capital that was really earmarked for that purpose. Just hasn't seen its day yet.
For sure. And that's another reason why I don't think that we're going to see the wave of foreclosures that we did, last time. There's so many variables with that and so much more money. And to prove the point, and unintentionally you said it, about the number of homes that are free and clear right now, most of those are corporate owned homes, right? And those guys, so the corporations came into the real estate market in the last downturn. They saw that it was an amazing investment, and they've done very well with just their equity gains, but then the cash flow this whole time, they're just waiting for more opportunity to pick up homes like that. And I don't think, like you said, we won't even see them hit the courthouse steps because the institutions will be trading behind the scenes or selling off behind the scenes. There'll be big, bulk portfolio sales that'll happen on non-performing assets. And I really don't see how we have that kind of market again. And to be honest, I'm very thankful because that was not an enjoyable time.
It was a great buying opportunity, but really there was a lot of pain in the market. So, I mean, with every person that you saw pick up a steal on their house, you probably met 5 people that were just an absolute heartache, so it wasn't really fun.
No.
It was a good time to invest and to buy and kind of stack up your real estate holdings. But it's really a good time to kind of learn from. And that's why I thought, let's share, what we have right here. I thought it was really, really telling as to what's going on. What was the difference between 2008 and today? Because if we just think about the price point, we go, oh, prices are up, need to fall. Done, right? It's gonna drop. Then we start to actually look at what's going on with this. And we didn't even talk about how much money's in circulation. I mean, there's a lot of other lines we could have thrown on here, but just in its simplicity, more jobs, less homes on the market, less homes being built, lower foreclosures, drastically different market.
For sure. Black and white. All right, sir. Well, thank you. I think we nailed that. If you guys have any questions or concerns, or you want more information, or you want to debate some of that with us, be happy to do that. Feel free to reach out, and we will talk to you soon.
Thanks, guys.
Take care.